Good morning, folks, and welcome back to Almus Market Mornings. Geopolitics remains the front and center of focus. Things have escalated significantly since last week, and President Trump has reinstated the blockade on Iranian ships from today. What's interesting is that President Trump's latest message also seems to indicate the US will start charging a toll for vessels passing via the Hormuz Strait, basically for protecting it. This was also something Iran was intending to do. For the energy sector, this is not good news, and once again, the pressure is on. Inflation watchers would have a close eye on the print from US today. Good morning, JK. It seems no matter who is the winner in this battle, Hormuz will be a tolled waterway. What's your take?
Morning, Swaraj. So that's not something which is uncertain, but probably the world is preparing itself for such an eventual outcome. But if you look at it, both Iran and US, they are actually using Strait of Hormuz working as a or non-working as a leverage, to get their other demands met. So in the last few days, Iran said that the Strait of Hormuz will be closed until further notice. President Trump said that US was reinstating a naval blockade on Iran, and they will also escort all the commercial ships passing through the strait, but charge 20% on those cargoes. So it is definitely something both are using for gaining other issues resolved, like the sanctions on Iran, and from the US side they want the Iranian nuclear facility to be dismantled. All this, I think there is more. The real issues lie there, and Strait of Hormuz is being used as a leverage by both. I think amid all this tension, Trump also made a statement that a deal is possible. It depends on how we want to take it. Yes, to an extent I agree that these escalations do eventually calm down a bit, and then markets retrace whatever they have seen. But definitely yesterday's moves were quite significant. The 10-year yield after the oil went up to almost touch 85. So now from 70 to 85, you can imagine more than 15% rise. So the 10-year yield is at 4.61, which is the high. I mean, which is not very far from the high of the year at 4.68%. 30-year at 5.10, high this year at 5.2%. But the significant move is in 2-year at 4.20%, which is a 17-month high last seen in February 2025, when the market priced out rate cuts. That was in February 2025. Subsequently, of course, Fed did cut rates again by 75 basis points. Now we are back to square one. Market actually expects Fed to hike rates by as much as two times of 0.25 each. That is as per the market's current reading. We will have to see how things pan out, not only in geopolitics but also in the US economy. It's going to be a big day for US economy, because we'll get another reading on the monthly inflation data. See, the monthly inflation data expectations show that the headline is going to be negative at minus 0.1%. This is not totally unexpected, because oil prices have fallen. The year on year is also somewhat lower on the headline, but it is a core that is going to remain at 2.9%, where the services inflation remains sticky, and also people feel that the PPI inflation, which came high, was not fully passed on to the consumers. So that's also possible over the coming months. So all this indicates that the how the inflation trajectory comes today is very important. So if the headline disappoints by not coming down, that will be a big negative for the markets. Or on the other side, if the core also comes down, that will be another positive boost for the market. So all eyes on this. The other thing that we are seeing is Kevin Warsh's testimony to the Congress, where the lawmakers are likely to ask him questions, and it will be interesting to see whether he can say something more specific that will be better than the guidance that he gave during the Fed meeting. That's what the market is looking out to very closely. Meantime, Waller, who is one of the influential member in the FOMC, also said that if we get another hot reading on core inflation this week, FOMC will need to consider tightening monetary policy in the near term. And this is a very clear statement that he is making. And he also says that we should not wait too long, just like we did in 2021 and 22 to hike the rates. So there is the market and the lawmakers are mostly, or the policymakers are leaning more towards tightening now. Definitely, that's what the market is also reacting to. The other thing that market will be looking ahead to is the major financial companies, Bank of America, Citi, Goldman, and JP Morgan are going to announce their quarterly results today. So markets have already been on the tentative side. The tech sector stocks are already making one step up and two steps down. That's how it is behaving. So this is just the start of the earnings season, and we'll get, of course, the tech sector earnings, the AI companies. All that is what the market is looking ahead to. Overall, the dollar has strengthened a bit yesterday. Definitely on the euro, it is now trading around 1.1400, not able to hold the gains, but not able to break down also. Similarly, on the yen, tried to break 162.50, but market is cautious that about today's, not only about today's CPI inflation and what Warsh would say, but also on what Japanese lawmakers would do to contain the yen's weakness. So that's something that we look ahead to. In the meantime, yields are going up in almost all the countries once again, particularly the near-term yields are going up. So that's something that we'll keep a track on. Now the rupee almost at 96, and but for intervention, it probably would have been broken yesterday. We are now, once again facing the challenges of trade deficit rising. We had the trade deficit which came at 30 billion plus compared to 28 billion in May. If you look at the year-on-year performance, the import jumped 31%, while exports rose 16%. The month-on-month was actually a decline for exports from 45 billion to 40 billion, whereas import declined only by 73, from 73 to 70 billion. And the June services trade surplus was at 15.11 billion compared to last month 17.7 billion. So that explains to you why this month's deficit has been higher than last month. Overall, our exports has, in absolute terms, exports are doing well, but our imports are still on the rise. Recently, the gold imports have also risen. So the deficit is maintained at a higher level. Now, this is just one of the factors that is adding to fresh pressure on the rupee, because now we are seeing, while the foreigners' investment into Indian markets has been steadily being on the positive, import buying has been on the rise, once again because of the concerns on oil, Middle East tensions continuing and all that. So we've also seen PSU banks buying for defense and debt repayment. So all this is giving the importers added impetus to hedge more, so that's keeping the dollar rupee on the higher side. But still, 96 becomes a very a strong zone where RBI is likely to either intervene through policy or direct sale also. In the meantime, we also had the retail inflation in India, which came at 4.38%. Market was expecting around 4.2%. 3.9% was what was read last month. And this is the highest in the last 17 months. That is from December 2024, when it was at 5.22%. Now, this is close to what the RBI had also projected in their MPC meeting. They have projected the full year inflation at 5.1%, which is quite a distance from where we are currently. And the quarter one was estimated 4.2%. Now, yesterday's core inflation was also not giving any jitters because it came at 3.9%. So, as of now, inflation is not much of a concern for India. It is the challenges coming from rising oil prices, outflows from importers and other payments, and less optimism about the government RBI induced capital flows. And added to that, this time it is a strong dollar overall. So rupee is definitely in a position where it can become a bit sensitive, both from policymakers' point of view as well as unhedged importers' point of view also. So I think possibly, while it may hold around 96 levels for today, and overnight data in the evening, from US on the inflation, Kevin Warsh's statement, etc., could perhaps, as well as the geopolitical developments, we may suddenly see de-escalation in these tensions. That's a way we have experienced over the last several months. So that all these could perhaps give some relief to the rupee in the coming session. So, but as of today, it's going to be on a very wait and watch situation. Thank you.
Thank you, JK. And yes, for the rupee, multiple things not working out, especially on the flow side. Then we had a wider trade deficit in June, imports rising more than exports and slightly lower services exports. And of course, we are in a strong dollar scenario globally. 96 is an important level where RBI may be coming in to support the rupee. But otherwise, on the global front, we have Kevin Warsh's testimony to look forward to. At the same time, US CPI will be out today. There is a general expectation that, in June, when the conflict had subsided, we had the prices of energy prices coming in lower. So the headline and the headline in the month-on-month is expected to be slightly lower, but the focus will be on core inflation, and markets will be assessing whether there is any broad-based inflation picture in play. But otherwise, there is the short-term yields that have moved quite high, and US it's touched the 17-month high. Markets are expecting Fed to hike rates at least twice this year, and it looks like the way they are pricing, it may be sooner also, depending on how the inflation print is going to be. That's it from us today. Thanks for listening. We will catch up tomorrow with the fresh round of updates.